Up, I wanted to talk about some of the key economic and fundamental components that index traders should be aware of. We'll start with GDP growth. GDP growth is a relatively simple metric. It shows, well, the calculation is not simple, but the output or the understanding of what this represents is pretty simple. This is the growth of the US economy. If the US economy is growing at a rapid pace, that's generally going to be positive for stocks. And if the GDP is declining, that's going to be bearish. So what we've done here, as you can see, the yellow line is the forecasted value for the GDP number. And then the column is either blue or red based on whether or not it beat or missed on those numbers. So when we see beats and we see the economy is humming really good, that's typically a positive sign for stocks, and vice versa when it underperforms the expectations. Another key area of economic health is to keep an eye on the jobs numbers that come out monthly from the United States, specifically the non-farm payroll or the NFP event. Now, what this shows us is jobs growth over time. If the economy is seeing lots of jobs added, that's usually a good sign that people are employed, the consumer is healthy, spending will continue, and company earnings will likely be a good result, right? Strong earnings for stocks, great for the stock market. Poor earnings, not so great for stocks. And we can trace that back oftentimes in large part to whether or not people are employed or if people are losing jobs. This is a really key economic indicator for trading indices if you're going to keep a fundamental perspective in line.